Hello everyone, I had to trade this morning from scratch, knowing what I know about weak small cap momentum, offering risk, scanner traps, and how fast a green day can turn into a red one. I would do almost everything slower. Most people think day trading is about finding the biggest percentage gainer and jumping in before everyone else. But that is not really what this morning was about. This morning was about restraint. It was about realizing that the market can show you movement without showing you quality. And there is a big difference between a stock that is moving and a stock that is actually tradable. Today is Saturday, April 25th, New York time. Comment below what day and date you are watching from because I want to know when you are seeing this recap. And if you value this type of breakdown, support by subscribing and comment John A.G. Best. That tells me you want more clean trading lessons, not just hype around every blinking candle. So in this video, we are going to walk through a morning where the account finished green, the week finished beautifully green, and yet the actual setups were not beautiful at all. That is the strange part. From the outside, the day looks simple. A little over $2,000 added today. A very strong week overall. A month that started ugly, then fought its way back above water. Wonderful. Great. Thank goodness. But underneath that final number was a tape full of false starts. Big movers fading. Headlines that sounded good until you looked closer. No news spikes. Sellers sitting on the ask. Breakout levels that looked obvious, then failed right when traders started trusting them. And that is where the lesson is. The week itself was a major recovery. Monday started strong with a big green result. Tuesday was actually the most important day, even though nothing happened. No trades, no forced entries, no random clicking just because the market was open. That is discipline, and it is boring, and boring is sometimes the thing that saves you. Then came the big midweek day. Then another solid green session. Then today, smaller but still green. Put it together, and you get a week that repaired a really painful start to the month. Because earlier in the month, the account was down badly, not slightly red, deep red, somewhere around the high five-figure area. And when you start a month that way, it does something to your head. You begin thinking, I need to get it back. I need to push. I need to make the month look normal again. That is exactly when traders become dangerous to themselves. The market does not care that you want your month to look clean. The market does not care what number you had in mind. It does not care that last month was better or that your goal is still higher, or that you only have a few trading days left. The market gives you opportunity or it does not. And today it gave movement, not clean opportunity. Movement. Now, first thing in the morning, the stock that grabbed attention was LABT. It had made a huge percentage move, the type that pulls every scanner trader into the same room. It pushed into the low double-digit area after more than doubling, and for a moment it looked like the leader. And then, look at that, it gave back the move. Not a small pullback, not a little healthy dip. It basically surrendered the whole thing. When a stock does that, you have to stop celebrating the percentage gain and start studying the selling, because the move up is only half the story. The reaction after the move tells you whether buyers are actually in control. Here, they were not. That kind of fade matters even more in small caps because liquidity can be thin, float can be tight, and when sellers unload into a spike, the chart can fall apart faster than a beginner can adjust. From recent market updates, top gainer lists themselves even warn that the biggest movers can retrace sharply, and that is exactly the type of risk we were seeing on the screen. Then there was TRT. This one had already been moving over the last few days, so traders were watching it. But then an offering headline hit, roughly in the low eight-figure range, and the stock pulled back. Again, that is not shocking. When a company sells more shares, the market has to absorb supply. And when a small cap stock already had a run, new supply can feel like somebody dragging an anchor behind the chart. It does not mean every offering destroys a stock forever, but it does mean you need to respect dilution risk. A shelf registration or offering structure can give a company flexibility to sell securities, and that possible future supply can pressure sentiment if traders think new shares are coming. This is why you cannot trade only from the headline. You have to ask what is underneath it. And that brings us to ELPW, the main stock of the morning. This was the obvious one. And obvious is tricky. People think obvious means safe. No, no, no. Obvious means crowded. It means everyone sees the same breakout level, everyone sees the same pre-market high, everyone sees the same volume ramp, and if that level fails, everyone suddenly realizes they were not early, they were standing in the same doorway. ELPW popped up on the scanner around the low $3 area, and the first question was simple. What is the catalyst? That is not a fancy question. That is survival. Because a stock can move without news, but a no-news move deserves more suspicion. If there is a real catalyst, fresh buyers may have a reason to stay interested. If there is no catalyst, sometimes the move is just liquidity, a scanner alert, a short squeeze attempt, or a crowd chasing itself. ELPW pushed from around 3 toward 4 and then sold back down. That was the first warning. It did not mean the trade was dead forever, but it meant the stock had already shown you sellers were willing to hit strength. Then it came back up. This is where the trade became tempting. Volume started improving. Momentum indicators looked better. The stock was still the name everyone was watching. So the idea was reasonable. Enter near the upper $3 area, look for the breakthrough 4, and if buyers step in, maybe it opens up. But the market did not care about the plan. Instead of breaking cleanly, it double-topped. It hit that area, failed, and started acting heavy. That is the moment where you have to switch from hope to evidence. Hope says, maybe it still goes. Evidence says, sellers are still here. The trade made a tiny profit, basically a scratch win. Not exciting. Not a big green candle moment. But better than turning stubborn and letting a failed breakout become a real loss. And this is where many traders make the mistake. They take the first small profit personally. They feel disappointed, so they try to force the second entry. Then the second entry fails. Then they average down. Then the stock gets thicker. Then the ask stacks up with sellers. Then they are no longer trading a setup. They are defending their ego. That is how a green morning disappears. ELPW came back again. It pushed through the round number area and stretched a little higher, but it rejected again. Then it sold off. Then it came back to the same zone again. Same fight, same resistance, same problem. At that point, the right move is not to argue. It is to say, this stock is obvious, but it is not clean. And those are different things. You can draw resistance lines, you can connect highs, you can say, if it gets above this and holds, maybe there is something. But if it cannot hold, you do not keep anticipating. You do not keep buying the idea of the breakout when the stock keeps proving that sellers are waiting. Whether the selling is from insiders, short sellers, ordinary profit takers, or some company-related supply, you may not know, and you do not need to know. The chart already gave you the practical answer. Too heavy, too choppy, not worth forcing. After that, the scanner kept throwing names around. SCNI made a wild, low-priced move, but it was too cheap and too unstable for the type of clean trade we want. Those names can look exciting because the percentage change is huge, but the actual execution can be ugly. Wide spreads, fast reversals, halts, weird liquidity, all of it. Then KMRK came with a headline that sounded strong at first. Management was talking about a major revenue surge, something around a few times improvement toward a tens of millions revenue figure. Sounds good, right? Well, wait a second. Projecting revenue is not the same as reporting actual results. A company saying it expects growth is not the same thing as audited numbers already sitting on the table. That does not mean the headline is fake. It means it needs to be priced differently in your head. In a cold small cap market, traders are not just asking whether the headline sounds bullish. They are asking whether buyers will keep buying after the first spike. KMRK popped, then faded. So the market answered. That also connects to another type of headline traders need to be careful with. Analyst buy ratings. A buy recommendation can look bullish at first glance. People see it and think, well, somebody official likes the stock. Great. But if you check filings and see shelf registrations, possible share sales, or a firm connected to both promotion and placement activity, you should slow down. Maybe everything is disclosed properly. Maybe it is all legal. Maybe it is just normal capital markets behavior. But from a trading standpoint, you do not have to be the liquidity for someone else's selling. That is the skeptical counterpoint today. Not every bullish headline is bullish for the stock. Sometimes a headline creates attention. Attention creates volume. And volume can become the exit ramp for supply. So when SST popped on the scanner, it was worth watching, but it never gave a clean trade. It moved, dipped, pushed, and moved again, but not in a way that gave a setup with enough clarity. No trade is a decision, and sometimes it is the best one. Then NTIP showed up. This one had a little more promise. It had news. It popped, sold off, came back up, and volume started improving. So the plan was simple. Take the break through the high, catch the squeeze, and do not overstay. That trade worked for a moment. It pushed toward the upper $2 area, gave a quick burst, and offered a small profit. In and out. Thank you very much. But then it rolled over too, and that was the whole morning in one sentence. Stocks moved, but they did not hold. By around the middle of the pre-market session, the decision became pretty simple. The account was green, the tape was weak, the best names were not following through, the risk of giving money back was starting to look bigger than the reward of staying aggressive. So you stop. That is not weakness, that is professionalism. If you're successful, share your success story in the comments so others can stay motivated. Now, the bigger picture is this. The month started with a painful drawdown, then recovered. The current month is not as strong as some recent months, but it is green, and that matters. Could the next few trading days still deliver enough momentum to push the month much higher? Sure. A couple of clean trades can do that. We have seen it before. But it depends on catalysts. It depends on liquidity. It depends on whether stocks actually hold their moves. And there is a fresh backdrop traders need to understand. Regulators recently approved changes replacing the old pattern day trader framework with new intraday margin standards, which means retail day trading could become more accessible, but easier access does not remove risk. FINRA still warns that day trading can be extremely risky and is not appropriate for people who cannot afford major losses. That is important. More access does not mean more skill. More trades do not mean more edge. More movement does not mean more money. So next week the plan is simple. Watch the scanners. Respect real catalysts. Be skeptical of offerings. Read filings when something smells off. Do not chase every shiny spike. Trade aggressively only when the setup is actually good. If the market gives clean opportunity, take it. If it gives chop, protect the account. Because the goal is not to force a pretty monthly screenshot. The goal is to survive long enough for your edge to matter. So yes, today was green. The week was strong. The recovery was real. But the bigger win was not the dollar amount. The bigger win was stopping before a weak tape took it back. And one more thing, because this is where people misunderstand consistency. A small green day after a monster week can feel disappointing only if you are addicted to action. But if you are building a career, a small green day in bad conditions is not small. It is proof that you can change gears. You can press when the market is hot, and you can pull back when the market is thin, tired, and full of fake breakouts. That flexibility is the real skill. Anybody can say they are disciplined when they are winning. The test comes after a drawdown, after a big recovery, when the account is green and your brain starts whispering, "Go get more." That whisper is expensive. It sounds confident, but it is usually impatience wearing a nice suit. So if the next session opens with clean news, strong volume, tight spreads, and stocks holding their highs, then yes, you can step in with conviction. But if the scanner is giving you the same kind of action we saw today, quick pops, heavy asks, vague headlines, and immediate reversals, then the best trade might be closing the platform and keeping the green. That is not glamorous. But neither is blowing up because you needed one more trade. The account does not care whether your patience looked boring. It only cares whether your decisions kept you alive for the next clean setup. And today, that was the whole game. Nothing more complicated than that. Trade carefully, manage your downside, and remember this is only for education and market discussion. I am not telling you what to buy, sell, or trade. Your money, your risk, your decision. Learn the process before you ever try to copy the result.